Hey Dennis, what's going on? How are you doing?
Great. Nice to see you, Andy.
Good to see you. Yeah, what
Yeah,
a
good.
crazy time that we live in.
Oh,
We
yeah.
obviously this past week we had the Fed meeting, raised it 0.25. Just want to see what your overall thoughts and impressions are on all of this and what the Fed is doing and how this is affecting your outlook.
Well, the Fed, basically, I've been in agreement with them for the last year and a half. We all know that what happened in 2008, the horrible banking crisis and basically close to depression. We had to save uh, the economy, save the banking system, and it was painful, but it was the right thing to do back then. Unfortunately, they instead of doing the QE for 2 3 years and stabilize the system, they decided to do it for another 10 years, which they overdone it, they overstimulated, and that started to cause inflation. And then we all know that the pandemic happened, and again, we had to do certain things, absolutely, otherwise the economy just completely was shut down. But we overdid it. Way overdid it. I mean, printing $7 trillion is just too much. So we should not be surprised that this is an inflationary environment. I mean, it was just created, and when you add another 30 to 40% of total GDP in terms of printing money to the economy, obviously the prices go up, and they go up everywhere. Now,
Right.
I think I agree with the Fed what they did when they started raising rates about a year and a half ago, a little over a year ago. And the Fed always follows the 2-year note. If you look at the chart throughout almost 100 years of history of the Fed, that's what they do. And that's the right thing to do. The 2-year note is always ahead of them. Fed is always behind. So I think the fact that they raised it to about, what are we, 5.25% now, the short-term rates, I think it's about right. What's happening now is the 2-year note, since the new banking crisis started about a month and a half ago, the 2-year note dropped. So right now the 2-year is at about 4%. So I think the Fed is done as far as raising rates. I'm not sure if they're going to cut yet. It depends on their recession, and that's kind of probably the next topic that we should talk about. But I believe they're done raising rates. So if you look at Fed funds futures going forward this year, I didn't look, I looked for about a year and a half out, and they're trying to price in either nothing or cuts down the road. We all know the inverted yield curve, and we all know that the recessionary forces are starting to show up. But we've been talking about this recession or slowdown for about a year. And so far, the economy is extremely resilient. I mean, if you look at unemployment, it's still very low. And I was kind of in the bearish camp for the last few months and thinking, it's going to show up. I mean, and when the banking crisis started, when the first bank went down and the second one, and now last week we had 2 more, and who knows how many more. I know they're not big banks. Big banks, I think, are fine. So they're well capitalized. But the regional banks, smaller banks, and they're vital to the economy. They provide so much credit to not only to big companies, small businesses, real estate, everything. So that's a concern. But you look at the reports, economic reports, and they're still fine, and kind of a little bit mind-boggling. So I thought the economy would slow. I'm not predicting a depression or anything bad like that. But my expectations were so the economy would slow down, would go into at least a mild recession, and unemployment would go up and so on and so forth, and Fed would, normalize it and maybe follow it and start cutting rates, or at least not raise anymore. But the thing is that the economy is still resilient, and I don't see it in economic reports, and very few of them. For example, the report that came out yesterday, the unemployment report, is kind of Goldilocks, in all seriousness. I mean, I thought, and a lot of economists thought that, it's time for a slowdown, but it's not there. So it's
Right.
kind of, as far as inflation is concerned, I think it's going to be persistent, but it's not going to be as bad as it was last year when it went to like 9% or something.
9%. Yeah.
So I don't think we're going back to 2%, the target that everybody wants. I think it's going to be somewhere in between 4 or 5. I'm just, maybe I'm guessing, because there's so much money, as I said, that have been printed, and it takes a long time to go through that. Plus the pandemic disruptions, supply chain disruptions, and things of that nature, they still exist. So the inflation is going to be there, but it's sort of interesting to see that if we're expecting a slowdown, then the inflation's supposed to go down, and we just don't see it yet. So we kind of will be waiting for it, at least I'm waiting for it, and I don't see it yet. And that reflects the S&P 500, for example, the stock market. It's been stuck at the same level for what, 5 or 6 months now.
Yeah, I'm looking at a chart right now.
Yeah, it's between basically between 3,800 and 4,200.
Yep.
Yeah, it depends on the reports and the news, and 3 days up, 3 days down, so on and so forth. We'll talk about it later, but that confusion is reflected in the equity market. So
right,
we can talk about equity markets a little bit more in detail, but that kind of
let's look at that. So what are you looking at? Again, you got this, it seems like this tension between inflation and deflation, if you would. How do you play this, game it out? How do you play this, whether you're managing money or whether you're trading? It's very confusing.
As far as my overall view over the last year or so, actually longer than that, I was kind of on the bearish side. And most of my bets were more on the bearish side. It's not like I'm bearish every day, but overall I'm thinking, the market is still overvalued.
Right.
It's not a timing tool, but it remains overvalued. Even if we're not pricing in the slowdown or recession, if we start pricing that, then we're way overvalued, and we should be like at 3,000. So the real value, I would say, is about 3,500 or something.
So 3,500, you're looking about a 12 to 15% correction from the current.
I've been looking for it for the last 3 or 4 months at least, because we were there last October, we were bounced. But if you look at S&P 500 by itself, as I mentioned, it's going nowhere, right?
Right.
But let's look at the internals and what we see.
Tell me, what do you see internally?
Well, the first thing is, when you look at regional banks, right, and they're being devastated. So if you look at the chart of KRE, it's making multi-year lows. It goes down just about every year. I'm surprised that S&P didn't follow it. Even XLF, the biggest banks, the index, the ETF, still down. It's closer to the lows of the year, while S&P is close to the high of the year. It doesn't mean that banks need to lead, but at least they have to participate, and they're going in a different direction. This is a bearish sign.
Right.
The thing is, the internals in general, the breadth of the market is not that great. The NASDAQ that is lately became kind of a safe haven, so to speak. The money goes into 4 or 5 biggest stocks, maybe 10, 15, and the same thing in the Dow and S&P. So it's not that healthy. Take a look at the small cap index, and then it's a broad index, 2,000 stocks, and it's very close to the lows. It almost challenged lows a few days ago. Again, this is not healthy at all. Right. You look at if you divide the small caps into small cap growth versus small cap value, it's the value that holds it up. The growth is being devastated. So that's not a kind of internal indicator that makes me worried. What are we doing? We've seen it back in the late 90s. We've seen it back in 2007 when a few number of stocks holding the index. So it usually ends up badly. If you look at how the consumer is doing, and as I mentioned, we're still kind of healthy. The recession is not here yet, but I like to compare 2 ETFs like XLY, which is a consumer discretionary ETF, versus XLP. XLP is a consumer staple.
Right.
And in a healthy environment, if you put a chart of XLY divided by XLP, kind of one of the internal indicator, so to speak, kind of health of the market. Usually in the bull market, in a normal environment, XLY outperforms XLP because people take more risks. You know, they prefer growth. They don't need to buy Coca-Colas, you know, or things like that. Right now, it's the exact opposite. XLP is the one that's going up, and XLY is barely holding there. That it's a good leading indicator. So look, it's just a few examples. So looking at that, I'm thinking that S&P is not going to hold here forever, and my view is still on the bearish side. I don't want to sound like there are a lot of bears out there right now, but when I say bearish, I'm not saying that, oh my God, you know, we're going into bear market for, you know, another year, 2 or 3, don't know. But I believe that the retest of, at least the retest of 3,500 on S&P is in intermediate term is in our future.
That's a little bit over 10%. So you're looking about 12% plus.
Something like that. Yeah, I would say between 10 and 15%, kind of written all over it. I don't know when. So
right.
When I saw the first bank started falling, so I thought, oh, this is it, because it's going to extrapolate the recession. Earnings will go down because they're not going to provide credit. Faith in some banks, in a lot of banking systems, so that's not good. But apparently we rallied. For a few days we rallied. Last week started going down because of, you know, a few other banks are in trouble, and then the economic report comes out Friday, and we rallied 2% immediately. So it's still at this range. How long? I don't know. A lot of indicators are pointing to at least 10 to 15% drop, and I've been waiting for it for a few months. It's not going anywhere.
So you as a go ahead.
Go ahead.
Well, you as a trader, two things. How do you play this? How would you specifically play this? And again, you have a background as a hedge fund manager and managing a lot of money. How would you trade this? Would you go short, or would you wait? Just wait for the sell-off and then become a buyer? And then what would, and then if you do wait, what would you buy?
I'm not waiting, actually. Well, I'm mostly an options guy. I don't go short. So I have either bearish option strategy where my risk is clearly defined, because I reserve the right to be wrong. And I've been wrong, like any manager, every trader, it goes up. So I know that I'm going to lose a certain percentage. So I have some long-term puts on S&P. So I was my other puts on like small caps, not just puts, they're put spreads and some butterfly spreads located below the market. They've been working. The S&P side hasn't been working, just sitting there doing nothing. So they're longer term. So I trade short term, but it's we'll be discussing that later. But as far as longer term, I mean intermediate term, 6 months down the road, 9 months down the road. So I'm looking at, let's say, 2023 in general. So I would like to. At this point, I think that the overall market will go down, like I said, 10-15%, and I'm betting on it. Not heavily, but I'm betting on it.
Right.
So, and I have long positions in different stocks. So something that I like on a micro level. They're wonderful, many wonderful stocks that, I mean, they can go down, and then they might go down with the market if it does go down. But overall, I mean, they're healthy and fine, so it doesn't have to be like a bear or bear down. So throughout options, that's what I have. If it happens, but when it happens, you ask me a question, if I'm going to buy something, yes, I will, but I don't know yet and what. How low does it go? Is the banking system sound? It's going to be sound that they're going to present tremendous opportunity there, because not every bank is going to go, there are a lot of small caps, as I mentioned. They're not doing fine right now, but you can find a lot of value in small caps even at these levels. And if they go lower, there are wonderful companies there. So on the upside, if it happens and when it happens, then I would be very selective, and I would go into just micro and look at a bottom-up approach instead of, because so far we've talked about top-down. So on the upside, I'll be more bottom-up and more selective about that. For example, I love energy right now, although I have positions in, like on the bullish side on XLE, OIH, but they're not doing great right now. Even 2 weeks ago when the OPEC said that they're cutting production, and there was one day when everything went up like
Right.
10% or something. So and all those stocks, but after that it just stalled and went down.
Right.
So,
We're right there. We're right back down where when they announced the cut.
well, yeah, exactly. And some of the indexes, some of the energy stocks are even lower, so they're kind of perplexing. And I have bullish positions in energy and bullish positions in gold. So gold because it's just safe haven, and energy because they're making a lot of money right now.
Yeah.
And I'm very surprised they're not higher than where they should be. They're cheap. They're really cheap, and oil is doing great. And whether crude oil is at 60 or at 90, it's basically irrelevant for them, because they're going to be doing great unless crude oil goes down to 40 or 30 or something. So which I don't see because of the geopolitical stuff.
Yeah.
Uncertainty.
I'm glad you brought that up. It's interesting. It's such an interesting time because I'm actually negative, not overtly negative on the market, but I am negative on the overall market, but I'm very long in my own portfolio, energy specifically, very heavy energy, just because of the value, as you talked about. It's just hard for me to see that as a losing bet, and just the multiples that these guys are trading at, and they're just making so much money. Exactly. And if they go down further, and I don't see oil going down much further than what it's currently at. I mean, I will buy more. And again,
I agree.
My positions are in pain right now, but I'm not in pain. I mean, it's like, it doesn't really bother me. I see it as an opportunity if they go down lower. And also, relatively speaking, my second biggest, my light just went out. My second biggest position is gold and silver. But that too, that's been pretty relatively flat. And I'm on the equity side. But it doesn't really bother me either, per se, but that's, I guess, how I'm playing that. But I guess if there's a concern of mine, if I see a massive deflationary situation, which we could have, I don't know what the percentages are, but we could have that. I mean, these things are going to really get smoked. So that's the risk, I guess.
Possibly, but I don't think they're going to get smoked. It's if it's a really bad recession, if it is, like we discussed so far, I don't see it yet, just only an indicator, but not in real life. I think, the crude oil might go down for a bit, because less demand, let's put it this way, can happen. But as far as gold is concerned, I think gold is not going to suffer much, even if there is a deflationary environment, which is maybe counterintuitive because gold is usually associated with inflation.
Right.
It's good for gold. Not necessarily, because when people are starting losing faith in banking system, and it's not crazy, they're not losing a lot of faith, but you've seen the outflows of deposits and a lot of regional banks, even banks who are doing fine. So it's just that people are concerned. They don't know what if this is the next domino to fall,
Right.
And that a lot of money goes to hard assets, something touch. So commodities, for that matter.
Yeah.
And it is the first thing that comes to mind. And that's why it's been doing fine. I mean, it's kind of flattish lately, but if you look at the longer term chart, it's going up. And I don't think gold is going to be affected by a recessionary or deflationary environment. I'm actually positive on it pretty much no matter what. So I believe it's a great long-term investment. A short-term, I hardly ever traded. I have allocation to that. Again, I do it through options, but and I'm not as proficient as you are in specific idiosyncratic gold stocks. So I kind of use gold or gold ETFs. So, but I'm bullish on them regardless of that. And what you mentioned about energy stocks, unless it's a horrible recession where demand goes down so much, and I don't see crude oil collapsing.
Yeah, I don't either.
War in Europe, and there's so many things, and those companies are cheap. They're
Yeah.
cheap now.
They're so cheap now.
Yeah,
And I
I'm
guess,
sure. It's disappointing short term. Yeah, I'm down this
yeah,
month. In those
no, I'm down quite a bit. I mean, 20% or whatever. But again, I don't, I'm not really bothered or concerned about it.
Yeah, I agree with you.
So this week, what do you got coming up? What are you looking at this week coming up, before we talk again?
I think it's going to be kind of a slow week. The market is confused. I'm confused as well. I think the biggest thing, the banks. So I think if another one or two go down, then it becomes systemic. So no matter what the Fed chairman says, no matter what the Treasury Secretary says, you know, the job owning that everything is fine. It's their job to say that.
Right.
See another one or two, I think the market will crater and say, okay, that's enough. This is a little bit too much to handle.
Mm-hmm.
I'm not sure if it will happen this particular week, but
yeah, and that's why you have your puts right now.
right. So they're not short-term puts, but in the longer term. But I think it's going to be really hard to rally, really difficult to just go straight up. Again, we might have another week where we go up 2 days, down 2 days, but
yeah,
that's
no,
what
I would agree. I think
yeah,
at the best, it's again, we continue the range at the best, if worse. And again, I'm not trying to be overly apocalyptic, but we're gonna drop.
Yeah, if we start going down towards 3,800 or so, we'll break it. Then yeah, we're going down.
We're gonna go lower. Okay.
Yeah. So
all right.
I think a lot depends on banks. A lot. So
yeah.
Another one or two in the market says that's it. So we're done.
Got it. Well, Dennis, what I'd like to do is we'll reconnect in a week or so. We'll give a review of where the market's at and what you see going on. And if anything drastic happens or we see something drastic happens, we'll get you on maybe midweek, just for those out there that are interested in listening. So
absolutely. And next time we talk, I'll present a few charts and a few whether economic indicators and just charts what I'm looking at, so our viewers can see and see where the ideas come from and what I'm looking at.
excellent. All right. Thanks, Dennis. Appreciate it.
Thank you, Andy. Anytime.